The world's largest central bank claims it can control the economy, but the numbers tell a very different story. Inflation is rising, debt is skyrocketing, and markets are acting like the Fed is no longer in the pilot's seat. In the last decade, the U.S. national debt has doubled, surpassing $33 trillion, while interest payments alone now consume hundreds of billions annually. Ordinary Americans are feeling the pinch, yet the Fed insists it can manage the fallout with a few rate changes. Bond markets are sending signals the Fed seems unable to read, with yields spiking despite repeated assurances of stability. Investors are whispering what policymakers won't admit. The system is under stress, and the cracks are widening. Central banks were supposed to prevent crises, but recent shocks suggest they might only delay the inevitable. When trillions in liquidity are injected, prices rise, bubbles form, and debt becomes harder to manage, creating a dangerous loop. Look at the paradox. The Fed tightens rates to fight inflation, yet inflation refuses to fall. It prints money to stimulate the economy, yet growth slows. This contradiction is not theory. It is happening right now, and history tells us these signals are warnings, not anomalies. Consider the sheer scale of intervention. Trillions spent on emergency programs, quantitative easing rounds, and asset purchases that dwarf historical norms. Each measure was meant to stabilize markets, but each one also sowed the seeds of future instability. Across the globe, central banks are chasing shadows, trying to control markets they no longer fully understand. When institutions lose credibility, every rate hike, every statement, every policy becomes a gamble with billions at stake. History has shown that economic collapses often start quietly, invisible to the public until they explode. The early signs, the debt, the inflation, the yield curve inversions, are flashing red, yet the conversation remains strangely muted. The paradox is stark. The very system designed to maintain stability might now be the biggest source of risk. Commenters online are divided, some calling it fear-mongering, others warning that the Fed may have truly lost control. This documentary will trace the patterns of past crises, expose the mechanisms that central banks rely on, and reveal why today's economy might be repeating mistakes history already documented. Viewers will see evidence, numbers, and warnings they cannot ignore. Debt has always been a double-edged sword in economies, capable of fueling growth, but also sowing instability. When governments borrow excessively, interest obligations rise faster than revenues, creating a pressure cooker that eventually affects every corner of the economy. Expansionary monetary policy was meant to smooth economic cycles, but it often leads to unintended consequences. Printing money or lowering interest rates may stimulate short-term growth, yet it can inflate asset prices far beyond sustainable levels. Credit cycles follow predictable patterns. Easy lending encourages risk-taking, creating bubbles in real estate, stocks, or government bonds. When confidence falters, these bubbles burst, revealing the fragility hidden beneath apparent stability. Central banks rely on the belief that they can control markets through signaling and liquidity injections. However, market reactions frequently defy policy expectations, showing that perception often outweighs the mechanics of monetary policy. Quantitative easing, a tool designed to support financial systems, has now become a permanent fixture in modern economies. By buying government securities, central banks artificially suppress yields, but this also encourages borrowing beyond prudent limits. Interest rate adjustments are another primary lever, yet their effectiveness diminishes when debt levels are historically high. Raising rates to curb inflation can trigger defaults, while lowering rates to stimulate growth risks, further inflating debt burdens. The feedback loop between debt, inflation, and currency stress is relentless. Rising debt increases interest payments, which can force additional borrowing, pushing inflation higher and weakening currency stability. Currency devaluation is often the hidden consequence of aggressive monetary expansion. As the supply of money grows faster than the economy, purchasing power declines, eroding trust in the currency domestically and internationally. Financial markets, while appearing rational, often react emotionally to these pressures. Investor panic can accelerate a crisis, turning a slow buildup into a sudden collapse. The central bank's control is always limited by external constraints, global capital flows, foreign reserve holdings, and political pressures. These factors often force policy decisions that prioritize short-term stability over long-term sustainability. Sovereign debt cycles demonstrate that history is rarely kind to repeated mistakes. Countries that ignore early warning signs often face defaults, restructurings, or severe inflation, leaving economies weakened for decades. Regulatory frameworks are intended to prevent systemic failures, yet they are often reactive rather than proactive. Loopholes, political influence, and outdated legislation can allow excessive risk accumulation without immediate consequence. Banks themselves amplify economic cycles through leverage. When credit is abundant and perceived as safe, lending grows, but when confidence wanes, the same leverage accelerates bank failures. Credit expansion does not only affect corporations and governments, it directly impacts households. Rising debt-to-income ratios make consumers vulnerable to interest rate shocks, creating a feedback effect on the broader economy. Historically, the combination of high debt, monetary intervention, and weak regulatory oversight is a recipe for instability. Each cycle builds on the previous, making the next collapse potentially more severe. The pattern is visible in almost every major financial crisis: debt accumulation, policy intervention, market distortion, and eventual correction. Recognizing these patterns allows us to see warning signs long before the crisis becomes headline news. Even technological and financial innovation cannot fully insulate economies from these cycles. Derivatives, high-frequency trading, and globalized capital flows may shift the timing or magnitude of crises, but the underlying mechanics remain unchanged. Central banks operate in a paradoxical environment. They are tasked with preventing crises, but create conditions for the next one through their interventions. The very tools designed to stabilize the economy often store instability for future generations. Public perception often lags reality, giving policymakers a false sense of control. When trust erodes, whether in banks, governments, or currency, markets respond violently and control becomes an illusion. Ultimately, the pattern reveals a simple truth. Economic stability is fragile, and history repeats itself. Ignoring the mechanics of debt, credit, and monetary policy is not an option if we hope to understand what comes next. After World War I, Germany faced astronomical reparations under the Treaty of Versailles, totaling 132 billion gold marks. To meet these obligations, the Weimar government began printing money at unprecedented rates, destabilizing the economy. By 1922, the Reichsmark had already lost more than half its value against the dollar. Citizens watched their savings evaporate as prices soared daily, and basic goods became unaffordable. Hyperinflation accelerated in 1923, with prices doubling sometimes within hours. A loaf of bread cost 200 billion marks by November, demonstrating how debt-driven money printing can destroy a currency's value. The Reichsbank continued issuing currency to cover government deficits, ignoring early warning signs. This unchecked expansion of the money supply created a self-reinforcing inflationary spiral. The social consequences were profound. Pensions, wages, and savings lost meaning overnight. Middle-class Germans suffered the most, fueling political unrest and setting the stage for radical movements. Meanwhile, the government relied on short-term loans from foreign banks to temporarily stabilize its finances. These measures provided temporary relief, but added foreign dependency, which increased vulnerability to external shocks. The Weimar crisis demonstrates a clear sequence: excessive debt, aggressive money printing, inflation, currency collapse. Central bank interventions, rather than correcting the problem, amplified the economic instability. Fast forward to Argentina in 2001, a different but equally instructive case of sovereign debt collapse. Argentina had accumulated $132 billion in external debt, representing nearly 50% of GDP, while pegging the peso to the US dollar. The currency peg was meant to curb inflation, but limited Argentina's ability to respond to economic shocks. When debt obligations surged, the government could no longer maintain the peg, and the peso collapsed. Interest rates soared to 40% in late 2001, pushing companies and consumers into default. The banking system froze, withdrawals were limited, and social unrest exploded across major cities. The International Monetary Fund had pushed austerity measures in an attempt to stabilize the economy. However, these policies reduced growth, increased unemployment, and deepened the debt crisis, showing how policy missteps can exacerbate collapses. By the end of 2001, Argentina defaulted on $95 billion of sovereign debt, the largest default at the time. The country entered a deep recession, demonstrating the lethal combination of overleverage and rigid monetary frameworks. In the US, the savings and loan crisis of the 1980s shows that even a seemingly stable banking system can collapse under poor oversight. Over 1,000 S&L institutions failed, costing taxpayers over $124 billion in bailout funds. Deregulation in the early 1980s allowed S&Ls to engage in riskier commercial lending. Combined with rising interest rates and falling real estate values, this created a financial disaster that regulators struggled to contain. The crisis exposed the fragility of institutions assumed to be conservative and low risk. Loose monetary policy had encouraged excessive borrowing, while regulatory gaps allowed systemic vulnerabilities to grow unnoticed. Each of these cases shares a common thread: debt accumulation, policy missteps, and central bank or regulatory failure. The timing and location vary, but the mechanics repeat across decades and continents. Weimar Germany shows hyperinflation, Argentina demonstrates sovereign default, and the S&L crisis highlights institutional fragility. Together, they illustrate the universal vulnerability of financial systems to debt-driven stress. Historical debt crises often begin with small imbalances that escalate into national emergencies. Central banks and policymakers frequently underestimate the compounding effects of debt, inflation, and market panic. Hyperinflation, currency devaluation, or systemic bank failures often arrive suddenly, even after long periods of relative stability. By the time warning signs are obvious to the public, corrective measures are often too late. The pattern is always similar. Governments borrow heavily, central banks intervene, markets react unpredictably, and the public suffers. Lessons from history remain relevant because the underlying economic mechanics rarely change. Sovereign defaults, like Argentina's, show how external debt can trigger cascading failures across banking, employment, and social stability. Investors and citizens alike lose confidence, accelerating capital flight and economic contraction. Even well-intentioned monetary policies, such as the Weimar Reichsbank's attempts to fund reparations, can produce catastrophic unintended consequences. Printing money to cover deficits destabilizes trust in currency, demonstrating a key lesson for today's debt-laden economies. Banking crises like the U.S. savings and loan episode highlight another dimension: institutional risk. When regulatory oversight fails, leverage multiplies, and even modest economic shocks can trigger massive bank collapses. By studying these crises, we see clear cause and effect chains: debt, monetary intervention, market reaction, social consequences. Each case reinforces the lesson that short-term fixes often create long-term vulnerabilities. The historical record is not merely anecdotal, it is a roadmap of systemic risk. Understanding it allows us to identify the same patterns emerging in today's global financial system. The Latin American debt crises of the 1980s offer additional lessons in sovereign overleverage. Countries like Mexico, Brazil, and Chile borrowed heavily in foreign currencies, making them highly vulnerable to interest rate shocks and global economic swings. When U.S. interest rates surged under the Volcker Fed in the early 1980s, debt servicing costs skyrocketed for these nations. Default and restructuring followed, demonstrating how external factors can amplify domestic vulnerabilities. Mexico's 1982 debt crisis forced the government to negotiate with the IMF for a bailout of over $1 billion. This period saw massive capital flight, devaluation of the peso, and a decade-long economic slowdown. Brazil faced similar pressures, with foreign debt exceeding $90 billion by the mid-1980s. Inflation soared past 200% annually, revealing how high leverage combined with weak fiscal management can create a self-perpetuating cycle of instability. Chile, despite careful policy adjustments, experienced banking strain as rising interest rates pushed private and public debt to unsustainable levels. The resulting recession demonstrates that even countries with disciplined monetary policy are not immune to global financial pressures. These Latin American crises underscore a critical point. Debt denominated in foreign currencies adds layers of vulnerability. Currency mismatches amplify the effects of global rate changes, making domestic policy interventions less effective. Another instructive case is Japan's 1990s asset bubble collapse. Excessive real estate and stock market speculation, fueled by low interest rates, created a bubble worth trillions of dollars. When the bubble burst in 1990, the Nikkei lost nearly 60% of its value over the decade. The banking system became burdened with non-performing loans, initiating a prolonged lost decade of stagnation. Japan's experience illustrates how even high-income developed economies can experience prolonged crises when credit is misallocated. Central banks can mitigate some risk, but cannot fully prevent systemic consequences of excessive leverage. The Asian financial crisis of 1997-1998 also follows this familiar pattern. Thailand, Indonesia, and South Korea borrowed heavily in dollars, leading to rapid currency collapses when investor confidence eroded. Indonesia's rupiah fell by over 80% against the dollar in 1998, and the government was forced to accept an IMF bailout exceeding $40 billion. Bank failures and social unrest followed, showing again that debt, leverage, and weak oversight can produce dramatic economic fallout. Thailand's crisis began with a collapsing real estate bubble, amplified by excessive foreign borrowing. The currency peg could not hold, leading to sharp devaluation and the collapse of the financial sector. South Korea faced similar pressures, with short-term foreign debt reaching $60 billion in 1997. The government intervened with bailouts and restructuring, yet unemployment and corporate failures highlighted the limits of policy control. These crises show that patterns of debt accumulation, currency mismanagement, and policy errors are universal. Geography, culture, or income level does not prevent the mechanics from repeating. Even in Europe, the Greek debt crisis of 2010 provides a modern historical lesson. Greece's public debt exceeded 170% of GDP, fueled by decades of overspending and structural economic inefficiencies. Interest rates rose sharply when investors questioned the government's ability to repay, pushing the country toward default. International bailouts required austerity measures, triggering widespread social unrest and economic contraction. The European Central Bank, IMF, and EU intervention prevented an immediate collapse, but at the cost of long-term economic pain. Greece's case shows that even within integrated monetary systems, debt mismanagement creates systemic risk. Historical case studies repeatedly demonstrate that central bank interventions can delay but not eliminate economic crises. The same patterns, debt, leverage, inflation, policy missteps, emerge over and over, providing a roadmap for understanding contemporary risks. The evidence is clear. Economies that ignore early warning signs of debt stress, excessive borrowing, or asset bubbles are vulnerable to severe corrections. Market signals often precede policy responses, and ignoring them comes at a high cost. From Weimar Germany to Argentina, the savings and loan crisis to Japan, and from Asia to Europe, the mechanisms are strikingly consistent. Debt drives instability, policy interventions often have unintended consequences, and banking systems amplify risk. The historical record leaves no ambiguity. The combination of debt accumulation, monetary mismanagement, and regulatory gaps has repeatedly led to crises. Recognizing these patterns is essential to understanding why today's global economy might be repeating similar mistakes.